a little early. Okay, it's Monday, September 8th, 2025, and this is the Finance and Audit Subcommittee, and all of our trustees are present. Do we have any public comment? Rita?
I haven't received any. No.
No? Nobody? Okay,
No one on Zoom? Good.
we will move to the budget, which is item 3. And so that's you, Chris.
That would be me.
How would you?
Okay, we'll take a look at the presentation for the adoption of the budget. And if you have any feedback as we go along for how to improve it, please let me know. So the agenda will be the assumptions, the budget summary, take a look at the general fund, some comparisons, a couple charts related to the budget. So I didn't update that. I need to fix that January versus June projections. That was from tentative. I apologize.
Is that just coming out?
Yeah.
Okay.
Yes.
What's coming out?
The January projections versus June projections, that was from tentative. I apologize for that on the agenda.
Okay. I think we're probably not picking that up. We have to talk louder
Oh, okay,
for tape.
sure.
Okay.
5-year projections and Q&A. So on the assumptions, which is page 3 of the presentation, the system-wide assumptions we're basing on the 25-26 enacted state budget, 2.3% COLA for the SCFF calculation and traditional categorical programs, EOPS, DSPS, CalWORKs, no COLA for the largest categorical programs, student equity and achievement, strong workforce. The deficit, no deficit factor in 24-25, and the deficit factor backfill was removed from 25-26. So it could come back, but we don't anticipate it as of yet. And as a district, we don't budget the deficit factor.
Sorry, when you say no COLA, that means that those programs did not receive additional funding.
Correct.
Okay,
And that's been true for a few years, unfortunately.
okay. And that's not the staff in those programs are not receiving a COLA increase. It's that the COLA adjustment is not being applied specifically to the funding for those programs overall.
COLA increases are done through contract negotiations. So the program as a whole did not receive additional funding, but that doesn't necessarily determine contract negotiation.
Got it. Okay, thank you.
For staff.
For staff.
Correct.
Yeah.
STRS rate is remaining at 19.1. The state is continuing to buy down the difference.
I'm sorry, can you just explain a little bit about the STRS and PERS rates? Like
Sure.
what that means, and is higher better for us, or
Lower is better.
lower better?
Yeah.
Okay.
So
I mean, or for the workers, or for, I mean, how, can you just explain it?
yeah, sure. So there are 2 groups that determine defined benefit retirement. One is state teachers retirement system. One is public employees retirement system. STRS, state teachers retirement system, tends to be for faculty. PERS tends to be for classified and classified administrators, and STRS for faculty administrators, typically.
Okay.
So the rate that they do, that organization does a big calculation to say, based on how many members we have and how much they're earning and when we think they're going to retire, we need to collect so much money to keep the system funded. And based on that, they set a rate. The STRS at the statewide level, they have had a commitment in the last few years to keep the rate that the employer charges that we pay as a district to STRS for each employee at the same level that it has been at 19.1. If there's a cost increase, that cost increase is picked up by direct payments from the state to STRS. It's not exactly direct payments. What they do is they say, okay, the difference is this much. District, you pay STRS that, and the state, we're going to give you the same amount. So it doesn't cost us anything, but it's like a pass through. but it keeps the rate that we owe per dollar that we pay employees in salary at that 19.1.
I see.
So for us, lower is better in that sense, right? PERS, similar. PERS doesn't have that buy down at the state level. So it, for the last few years, has gone up pretty significantly. It's a little bit surprising that it actually went down slightly for this year. But I think that has everything to do with the way PERS is investing their money and the performance in the stock markets. So they said, well, at least for this year, based on our portfolio, we can keep the rates at slightly lower than they were in the previous year. Could that change in future years? Absolutely. Yeah.
All right, thank you.
Sure.
Suggestion, at some point, and I don't know if it's here, it's helpful to give people a sense of how much that total number is. Because we often talk in terms of how much it increases each year, but I don't think we often know what the total is.
Okay.
So, I don't know whether this is the place, but somewhere in the discussion.
Okay. There is later when we do 23-24 versus 24-25, there's a benefits page and it does show STRS and PERS year versus year comparisons. So at least that part is in there.
Okay.
But would you
Yeah.
like to see how much of the budget we're talking about?
Yeah, I mean,
Okay.
when it's this percent of two large groups of our employees,
Yeah.
that's a fair amount of money, and I think
Yes.
it helps us to remember to see that
Okay,
number.
sure.
And that percentage is based on their salary? Is that a percentage?
Correct.
Okay, and then so if someone gets $100,000, then the college pays that 26% of that
Correct.
In addition,
in addition to their salary. Okay.
Right.
Okay.
Yeah, so for STRS, for every dollar we pay 19.1 cents. And then for PERS, for every dollar we pay 26.81 cents.
Okay.
The system as a whole has growth funding for up to 2.35%. That won't impact us because we're not growing as a district in that sense. And they reduced the SCFF deferrals. I think I mentioned this at the previous month's meeting to 4.1% versus it was over 5%. That impacts cash flow, but not budget. And those deferrals will come in the last 2 months of the year, we anticipate. And then they'll be repaid in July of the following. So they'll come in May, June 26, and then they'll get the money in July 26.
If we have Maria here, do you have any estimate of where we are on enrollment right now?
I do year to year or,
Well, fall to fall
Yeah.
or year to year, whichever works.
yeah, as of this morning, we are about almost 4% down in head count compared to exactly a year ago in head count,
Okay,
compared to exactly a year ago. If we look at the last 3 years, however, it looks pretty flat, meaning because last year we were up from the year before. But this year we're down compared to last year, exactly last year in head count. Actual enrollments, we haven't really pulled the numbers quite yet. We're waiting for census, which is tomorrow, to do that.
okay. And those numbers don't always include, they're pretty much apples to apples, I assume, but they don't include our dual enrollment
That's correct.
and late start
That's correct.
and I don't know if there's anything else. I suppose on the downside, there would be the cosmetology differences
Correct.
and the bots that are not students.
Correct.
So it's a moving target, I know.
Yes.
Okay.
Looking at these assumptions to put that conversation in context, so it looks like the discussion or the assumptions are 50% decline in international student revenue and 15% in out-of-state revenue, but we're not going to see that play out, you're saying, until tomorrow, until census happens tomorrow? Or would you be able to comment on the validity of these assumptions as we're do you see that actually playing out?
Yes, we do see these assumptions being fairly accurate assumptions, if there's such a thing of accuracy of
Right.
assumptions.
Yeah.
Yes,
Okay,
they're real assumptions.
excellent. They're realistic.
Yes.
Really assuming. Okay, great. Thank you.
Did we break down international particularly, I would think, on the basis of who's new and who's continuing? Because if your new students are what's falling off, then that ripples on through the following years because you don't have as many people continuing.
Yeah, that, yes and yes. We
Okay.
did do that comparison in that way that you described.
And what are we seeing in terms of the new students?
There is a decline in international students compared to new is really what we're looking at, not new to ongoing, new to new. My understanding from Vice President of School Extended Learning is that that is the comparison that we did, and we feel pretty certain that these are pretty good assumptions based on the numbers that we have thus far with international students.
Okay. So I could mention it later, but we have an assumption of no further declines in our 5-year projection.
Correct.
And I would wonder how good that is based on this whole problem of if the new students are declining, then you're still declining.
Yeah, so what we did in the actual budget is we put in 3 versions, a 3% increase, and we applied that percentage to all categories. Flat, we applied that to all categories, and 3% decline, and we applied that to all categories. But certainly as we get more information, we can update the assumptions as we go. And it actually brings up an interesting question. If, for example, international student revenue does worse, or let's say it does better, we won't know that until December, November, December. So a question then remains, is it in the interest of the board for us to come back and revise those assumptions and therefore revise the budget in January, let's say? And then you'll see later, as I start to talk about the student-centered funding formula and when those reports come out, similar question remains for, we get an updated report in February, and would it be in the board's interest for us to update the budget in March, for example? Or is that so late that at that point, it's better just to let things shake out the way they do and adjust for the following year? So
We had previously, and I think it's dropped out of our agenda, but we had a monthly report on the assumptions. And so we were asking basically, is the assumptions the same or are the assumptions changed? So the idea was that we would keep up with this so that when you had a more reliable report, such as you're describing, we would regularly have that on the agenda and we would know the assumption had changed. Now, whether that means you have to revise the whole budget, that wasn't included. What that would fall under is whether you're asking us to move anybody around.
sure.
So I think. So
I don't know. I mean, it's a good question. I don't know in terms of the enrollments themselves, if we get data often enough to present to you revised assumptions on a monthly basis.
Mhm.
I don't think we get data that quickly. I think quarterly probably would make more sense.
we could certainly be more flexible about that. The problem we had was that the assumptions didn't change at all before your time. They just stayed, no change, no change. And you could see that there should be a change,
Okay,
yeah, elsewhere. Okay, thanks.
sure. So, well, most of these are similar to what you've seen before. Medical insurance costs went up, combined utility rate increase expectation, minimal impact from step and column increases. So far, federal funding is continuing. Okay.
Is it though, at this?
The funding that we're receiving so far is continuing.
What does that actually mean? Which federal funding are we referring to?
We have 3 federal grants.
The
And-
grant funding then?
So far, they have not stopped those grants. And student financial aid has continued, although some of the criteria for that aid has been updated. And so that may impact students' ability to enroll and take courses, but we won't see that impact for at least a semester, if not a year.
Okay, so it's my understanding if the student financial aid went away entirely,
Hmm,
that would be catastrophic.
absolutely.
But you're talking about something that adjusts the qualifications or the amounts, and that could have incremental effects.
Yes.
The grant funding, if it were taken away, which seemed what seems to happen is they announce that they're taking it all away right now. And then there's a lawsuit about it.
Mhm.
So do we have a contingency for that?
There's no,
Brought up?
I'm gonna pop in here and say that at this point in time, the chancellor's office is just recommending a wait and see approach. If I had to guess, if all federal financial aid went away, I think California would step up as part of that, just like there's conversation around the UC about what they're going to do given the lawsuit that they're involved in. But I think at this point in time, there's really the thing that we're the most concerned about are our 3 HSI grants, because those are the subject of lawsuits, not our specific one, but there is an HSI lawsuit out there that the Justice Department doesn't want to defend itself against. And so I think we just have to take a wait and see. But in terms of financial aid, there's really nothing we can do at this point in time.
Well, I was thinking mostly of the HSI grants. I mean,
Yeah.
if they went away, do we have some contingency planning for
Yeah.
what we would do?
Yes, if they went away, for example, Melissa Menendez, she's a faculty member who runs our RAICES program. You know, I think she already has in mind that if she needed to, she could go back to the classroom because she is a full-time faculty member. The question would be, what do we do about, I mean, we have two other staff people who are on that particular grant who were hired with the understanding that if the funding went away, their jobs went away. So I think at this point, that's probably what we would do. But the question is, how would we continue to deliver services? Because of course we need to serve our students. So I think we're very aware that those are probably our biggest challenges right now, the RAICES grant.
Okay, thank
And
you.
Maria might be able to weigh in on more of that.
I think that we really have not gone to that discussion yet, honestly,
Yeah.
in terms of what would we do in the event that those grants were pulled. I suspect that we would rely on other sources of funding that wouldn't impact the unrestricted general fund, like strong workforce, for example, for some of those items. Our regular program review process and budget allocation process, et cetera, consolidation of some services. But to be practically candid, we have not gone there, probably in hopes, and also the likelihood of it becoming that way. And we don't believe that that's what's going to happen. In fact, just last week, we received notification that verifying that one of our HSI grants had received funding for this year, just last week. And so it's not so much hope, it's the likelihood of it happening. And so we didn't think that we would dedicate our resources and efforts to planning something that really is an unlikely event.
I will say also in terms of the potential state backfill, that a couple months ago, the state asked us to provide all community colleges to provide them with information on what federal grants do you have, what's their annual allocation, so that they can collect this information and be prepared in case.
Yep.
As much as they can be.
Yeah,
Mhm.
as much as they can.
Yeah. So on page 5 are the updated primary drivers. So the Stefan column is the same as before, PERS is the same, health and wellness is the same, utilities is the same. International revenue decrease changed because we did it on a 50% of 24-25 basis, and the 24-25 value went up slightly. So that number also went up slightly. And then the out-of-state revenue decrease is new at the adoption budget. It was not in the tentative budget before. That's the 15%. So that's an additional decrease there. So your total projected impact from those things is 3.8 million to the budget. Any questions there?
So just to clarify, you said the international revenue decrease, that's the 50%, and then the other one is the 15%?
Correct. Would it help if we put a little thing in the chat that shows that? Okay.
I mean, just to confirm that that's the same amount that we're talking about.
Yes, absolutely. Great. Thank you. All right, so page 6 is the full budget by subfund. The primary purpose I have in including this is to show you that the total for all district funds at the very far right in blue, and the change in fund balance there has dramatically improved from when we brought it to you at tentative. And if you'll recall, the reason that it looked the way it did at tentative is because we didn't presume bond funding yet. And now that we have the sale of the bond, that's included in the budget. And so this reflects actual differences, including that bond funding in the capital projects area. Okay. Page 7 is the unrestricted general fund, and you can see actuals for 3 years and projected actuals for last year. I'm very happy with the fiscal department. Thank you, Larry, for your leadership and all your folks for their work. So in the past, it took us far longer than it should have to close a fiscal year, and we're, let's say, 99% done with closing 24-25. So I don't want to say actuals because we're not quite there yet, but very, very close.
You're close.
You're still looking at the couch.
Anything I can find, yeah.
Very close. So I'm pretty confident in these numbers. And you'll see there that, and we'll go into a little more detail in the next couple of pages, that the impact on the fund balance is a positive 5.5 million, but that next year we're budgeting an impact of 5.8 million decrease. You saw from the slide we looked at just a second ago that 3.8 of that comes from those change in the primary drivers that we had, right? So if, for example, out-of-state revenue or international revenue is better than we thought, that'll certainly present a rosier picture. Or if we spend less, that would have less of an impact in those areas. So if we go to page 8, I tried to do a little more color coding and relabeling versus the version at tentative, so hopefully it makes more sense now. Less abbreviations in the labels. So the very left column is the projected, as you saw on the previous page, and then there's the COVID block grant. And so then there's the projected in peach, whatever color that is.
Peaches.
That works. That it would have been had we not moved the block grant money. And I'd like to say here that it's really prudent of us to have done that. So the state reached out to all community colleges and said, hey, you should probably spend that block grant money before we are asked to take it back. So having used it helps us in that way, because now the difference is in our reserves and we have more flexibility with that funding. But that's the difference had we not. And then that compared to budget is the green column, and that compared to the previous year is the blue column. So you can see that we did well compared to budget, especially in the salary categories and also in the services. And we did very well compared to the previous year in academic salaries and in some in equipment. But we still received $1 million less in revenue in 24-25 than we did in 23-24. Right. Any questions here before I go into the detailed pages?
I think that's helpful. That chart. Appreciate
Okay,
it.
good. And the color coding and the labeling is better?
Yeah,
I know at tentative it wasn't as clear.
yeah.
Okay.
Yeah.
So a couple questions arise. One would be, how could our revenue go up that much, right? So if we go to page 9, we'll take a look at, and this is one of the things I was alluding to earlier. If you look at the apportionment comparison, what happens is the amount of money we get calculated in June, that's at the top portion of this chart, that helps us determine the amount of money we're funded in July when we're in stability. So for 23-24, for 24-25, and for 25-26, we're in stability. So you can see those arrows. The 22-23 green becomes the 23-24 funded in green. The mauve becomes the mauve in 23-24 to 24-25, right? But you'll notice that every time they did the calculation in 23-24, the amount changed. In fact, it went up. Right, so the amount that we budgeted in 24-25 was in the mauve, I don't know what color that is. Pink, thank you. Pink,
Big.
purple, lavender, that one. And in June, in the February, they recalculated and said, you know what, you earn more, and so our value went up. And that difference is part of the difference between what we budgeted in revenue and what we received in revenue. Why did that happen that particular year? So we made a decision, and it was a good decision, in 23-24 to do what is they colloquially call the summer shift. So we're allowed to count enrollments for summer because it crosses 2 years, either when the class starts or when the class finishes. So in 23-24, we knew that the 24-25 value would become our floor going forward, become the minimum. So we wanted to bump up 23-24 as much as we could so that 24-25 would be as high as it could be, so that our floor would be as high as it could be moving forward. So we did what they called shifted, which is basically counting the enrollment in summer 2024 in the 23-24 year instead of in the 24-25 year, because it crosses fiscal years between when the semester starts and when the semester finishes. And that is what resulted in the orange calculation in 23-24, and then the orange funded amount in 24-25, which is a higher amount. Similarly, in the gray for 24-25, we used that number that they sent to us, which is 24-25's calculation plus COLA as our budgeted amount. That's the amount that we used for the student-centered funding formula, portion of the 25-26 budget. Could 25-26 change? It could. Why? It could change because we are continuing to change some of our numbers on the basis of standard attendance accounting. Now, we changed a good portion of them, but some of them haven't been impacted yet based on when the state chancellor's office wants those submissions. But the February number could be different because we're continuing to update those calculations. It could be slightly higher, could be lower, but it's possible for it to be slightly higher. So that would take us back to that question I asked earlier. We can certainly provide you with updates on the assumptions, but also, is there an interest in us revising the budget itself, or just making a note so that you're aware of it, so that the following year you can see why it changed? Because it's so late. We would get the report at the end of February. If we're going to update the budget, we would have to do that in March. Our fiscal year ends in June. So that's the questions we asked, I think.
Maybe a running total of changes, significant changes. So in December, you see the international out of state, you said, I think.
Mm-hmm.
So you tell us about that and you say it's plus this or minus that, whatever. And then in February, you see the standard accounting changes.
Mm-hmm.
And you say, okay, now it's changed to plus this, okay?
Mm-hmm.
And you just give us a running total like you have with some other things.
Sure.
So we see the amounts that are changing without you having to redo the whole budget. Does that help?
I think that would be easier for us to identify as well, rather than sifting through the whole.
Yeah.
Yeah, I think that's good.
Okay, so we would provide, here's how things are gonna change, so the actuals will look different by this much,
Right,
but we're not gonna redo the budget on that basis.
right.
Yeah.
But we're not surprised that there is a delta of some sort
When
based
we
on
get to
this
the end.
totals as it goes along.
Okay.
Or, they took away the HSI grants, so,
We would definitely.
whatever.
Okay, all right. So does this chart make sense?
Mhm.
Any questions on this chart?
Well, we're not moving summer again, right?
No,
Summer is staying where it is. And
yes,
did that play into the 4% increase last year?
Yes, it did.
yes.
Okay,
Yes, it did.
so.
All right, page 10 is sort of a summary of all of the changes to revenue. And so the student center funding formula we just talked about went from 1021 to 1038, so almost a $1.7 million difference. Interest came in higher than we anticipated. The stock market did really well. International came in slightly higher than we anticipated by almost 300,000. I don't really have a great name for this last one, and I'm curious if there's a name that you would like me to use. So in fiscal, they call it a credit write-off. We've had it referred to as a deposit refund. Here's what happens. Students pay for tuition, they drop a class. They're not automatically refunded that amount. They have to request a refund. If they don't request a refund after 2 years, we have to do something and say we count it as revenue. It does not prevent a student at any point, even after those 2 years, from saying, hey, I'd like my money back. They can still do that. But we have to record it in some way after it's set on the books for 2 years. So I don't have a great name to call it. In the accounting world, they call it a credit write-off because it's a credit on an account. It's basically students drop the class, but they paid for that class, but they don't ask for the money back.
Tuition credit write-off? I mean, I was puzzled by indirect costs because costs implies that when you went from 200 to 315, it cost us more. And that's not the way the math is working.
I can talk about that. But for deposit refund, tuition credit write-off, would that make more sense?
Yeah, maybe. I don't know. Somebody have a
Yeah, I
better.
never knew what that was, so that's a good explanation. I guess my question is it that standard practice to not automatically issue a refund?
It's something that we've been doing here for a long time. Now, it's not standardly that large. Because of the turnover in the student finance office, they didn't process those for a couple of years, so it's built up over time.
Okay,
And so
so
that's
it wouldn't normally be
that big.
$500,000 every year?
No.
So, and we don't expect it to be that next year?
No.
Okay. I still feel like it's kind of weird that, we're not automatically giving them a refund if they drop the class, like, it just seems like. I mean, we're making them go through extra work and hoping that they don't, so that then we get to keep their money, I mean, that's the way.
That part. I think it's worth a discussion about
Yeah.
either changing policy or changing communication with them to say, hey, if we're not gonna take any other classes, maybe you wanna make this request.
Yeah, it seems a little,
Mhm.
underhanded.
A little grabby.
Yeah.
Can I
Yep.
ask a related question?
Yeah.
Is that also the policy if the college cancels the class? So if I'm enrolled in a class and I pay the fee, and then the class is canceled for low enrollment or for any other reason, do I also have to request my money back if it's not even my fault?
I believe so.
Wow. I think that's true because I think it's happened to us.
Yes,
There.
yes. I definitely think that's something to look at. And probably it's something we didn't know to look at before until we saw this big number and went, wait, what is that?
I did get a notification though. It said, I got an email and say, hey, you need to request that money, otherwise you're not getting it.
You're right.
Well, I don't know who it would go to, but I would just suggest that we have somebody look into that,
Yeah.
that process, and a policy on that or something like that,
Yeah.
So,
Especially if it's true for ones we cancel as opposed to a student.
yeah.
Okay.
I mean, I know we're not looking for ways to give money away at this point, but I just, I think we need to be, ethical.
Sure.
Yes.
So again, for indirect costs, I'm open to renaming it as well. What happens is for the federal grants, they have a portion that we're allowed to charge.
Yeah.
When they spend a certain amount of money, we take an administrative fee, basically is what that becomes. And they spent more in 24, 25 than we thought they were going to. And so our administrative fee is higher. And that's basically what that is.
And
Right.
Chris, can I ask, does that also include our indirect that we get for being the fiscal agent of the SCRC, or is that somewhere else?
My understanding is that that is somewhere else, but I'll verify.
Okay. Okay, because that's when I saw that number, that's what I thought it was. I thought it referred to our being the fiscal agent.
Yeah, I'll double check.
Okay, thank you.
Sure. And then various is a huge hodgepodge of a whole lot of little things like non-credit clay sales being 34,000 above budget, et cetera. So I didn't want to list every little.
Yeah, that's all right. The costs thing, I'm not, that's where I'm thinking it should be subtracted, not added. So what about
Grant
federal
administrative.
federal agent or something, or overhead?
Or indirect cost recovery,
Yeah.
or, yeah, something.
Okay. How about indirect cost recovery?
Okay,
Perfect. I will change that label. Thank you.
that's good.
So slide 11 is just general notes, and a lot of these are similar to what you saw tentative. So academic salaries are very close to budget, but lower than the previous year. They came in actually better than we anticipated. Classified salaries are lower than budget from unfilled positions, but higher than last year due to filled positions. Benefits are higher, primarily from health and welfare increase and early retirement benefits increase. And you'll see in the later slide that the health and welfare increase is a pass-through and the early retirement benefit increase is a one-time fee. So we don't anticipate those items for next year per se. Services are higher than the previous year, but below budget, and especially in liability insurance, contracts, repairs, vendor, bad debt. Equipment costs are lower, and transfers out are higher, mostly from additional self-insurance expenses and childcare, fleet services, and parking.
Now, I probably missed this before, but we're not transferring anything to the construction fund. We used to do emergencies at least.
We did transfer to the construction fund because it was budgeted to do so, but not beyond what was in the budget. And we do not have that
in the
budgeted
list-
for next year.
That's what I'm talking about, not budgeting it for next year.
We have not budgeted for next year because most of the projects that we're doing are unrelated, or we're spending existing funding in that fund currently. So we didn't budget the transfer for 25, 26.
See, it's felt like we were under budgeting that. And I know we talked earlier about when you have time, you'll look at what our contribution is compared to the total cost of ownership
Yes,
that we should do.
yes.
So that may make sense, but it just feels like we keep not funding our own even emergency stuff.
I'll come back with the proposal at a future meeting. So I think the total cost of ownership can be typically is paid for in using three things.
Mhm.
One would be bond funding. Everybody uses bond funding. The other is state scheduled maintenance, which unfortunately the state has not provided for us in the last few years. And then the third would be local funding. Some districts have different models on how to create the local funding. Oftentimes it relates to sources of income that is not recurring every year, or it's unpredictable. So some districts, for example, take interest income and put that all in a general fund sub-fund for that purpose. So I'll come with a proposal at a future meeting.
Yeah, I mean, it was a big number that we should be spending for that third category, which is kind of your annual keep things up,
Yes,
and that we haven't done, so we don't have things kept up. But we haven't analyzed it in terms of what we are putting forward, like our custodial and landscaping and so forth.
Yes.
So, you know, I mean, it may be that we're already doing enough in the budget for what that number is, but it was like 6 million and it just doesn't feel like we're doing enough. And it doesn't look like we're doing enough when you look at our buildings and
Sure.
grounds.
Sure. I think the next meeting we have is November. So for the November meeting, I'll have the annual 311 report, which is due to the state in October. And then I can have that proposal ready for this meeting.
Okay.
Does that work?
But I think it's notable that we're not putting anything in, whereas we had at least put in 650, I think, last year.
Correct.
650,000.
650, yeah. Okay. Slide 12. So here we start to get into the details comparing 23, 24 to 24, 25 projections. This is the happy story we've been telling for the last few months, which is that productivity is doing very well in academic salaries, and that you can see the highlighted lines. The primary driver is hourly instruction, hourly non-credit instruction, and overload, for a total year-to-year savings of $2.6 million. Thank you,
Mhm.
to Academic Affairs, for driving that positive change in the spending trend. Any questions here? Okay. Classified,
I think that's a very important
I agree.
table.
I'm intrigued by this table because like, I didn't realize we had so many different categories of academic salaries, you know,
Oh.
so that's one of the, it's like, oh, we have teachers, right, you know, but no, it's not just.
No, it's.
So I think, and it's interesting to take a look at just the different categories and how some have gone up and some have gone down, so
Mhm.
I think I'd like to be able to learn more about the different categories on this at a later date, you know, so
Sure.
maybe I'll talk to you or somebody about trying to get more information about all of this.
Oh, sure.
Yeah, there's a lot of granular detail here.
Yes. And when we get to the budget slide, I consolidated that dramatically because the number of account lines we have in benefits is outrageously long. So I made it make more sense when we get there, so. Okay, classified salaries is the next, is slide 13. And you can see there that, as mentioned in the summary slide, that we did better than budget because of vacant positions, but we spent more than the previous year because of filled positions. And you can see the differences here. Total impact from one year to the next is about $700,000. On the positive side, two of those categories, regular classroom instructional aid and hourly student tutors, right, are folks that are involved in direct instruction in the classified service, but involved in direct instruction with the students.
And we're now getting FTES for some of that tutoring.
Yes, we are.
So
All of it.
all of it? All of it. Okay.
You can see a shift from staff tutors to student tutors in that, in those numbers. So. Any questions there? Okay. So the next slide 14 is benefits. And this is the one that's really condensed. You would expect STRS to go down since academic salaries went down, PERS to go up because classified salaries went up. And then you can see the health and welfare, the pass through is an increase, and that the early retirement incentive is a one-time payment. They were supposed to bill us at the end of 23, 24, and they didn't. They billed us in 24, 25. And so it looks like an increase, but really it's just a shift from one year to the next. And the payments to that early retirement incentive are coming to an end in the next 2 years. Any questions there? Okay. All right, the slide 15 is services. So you can see that services were 1.7 million below budget, and we adjusted the budget accordingly, which I think we've talked about at a previous meeting, but they were still higher than the previous year, primarily in contracts, which includes software subscriptions. And I know our consultant in the IT department is looking very carefully at all of the software contracts that we have. We took some that were 3-year contracts and we said, no, let's do it for a year so we can really do a deep dive and make sure we need to continue with that type of service in the future. So we'll have an opportunity to improve that in 26, 27, as we make decisions about some of those software that we may not need to pay for anymore. Facilities maintenance contracts, some bad debt expense. So this is the other side of the student one that we mentioned. This would be where a student signs up for a class they don't pay, and then we have to write it off. So if a student, for example, and this is the bots fraud that we try to get around, right? If a student signs up and then they drop all their classes, but they receive some sort of form of financial aid, we're on the hook for that. And so the bots are sort of the real challenge for us in that arena in terms of the dollars, at least. So that's the increase in the bad debt expense. And also, as we mentioned, we're sort of catching up in the student finance office. So some of that is multi-years coming together.
So in general, that we're seeing that number go up. I mean, everyone is seeing that go up because of what we're hearing about the bots.
They did right after COVID, and then a lot of folks did in the last 2 years, and then they're starting to see somewhat of a decline recently because everybody's
Aware of it.
aware and starting to do a little bit better. And then we are part of a statewide effort that uses AI to detect the bots. And so that is hopefully going to make a significant difference.
Are we seeing AI bots? Like fake people?
Oh, definitely fake people.
Well, I mean,
Have the
visually,
bad
fake-
actors used?
visually pretending to be a person, not a person.
Oh, I don't know.
No, we're not seeing that.
At this point.
I think I saw an article about that the bots were getting more sophisticated with AI as well.
Yeah. It wouldn't surprise me, unfortunately,
Yeah,
right?
yeah.
It's too bad they don't put that much effort into some legitimate enterprise, right?
Instead of theft.
Yes. Okay, if there are no other questions on that. All right, so this is a chart showing the percentage in each area. And there was a slight decrease in services based on the budget adjustment. It was 12 before, it's 11 now. And the slight increase in employee benefits, it went from 25 to 26 because the dollars shifted, basically. But overall, this is the same picture, similar picture to what you saw at Tech-Tiv. Okay. We updated the slide 17, the salary as a percentage of total. And you can see that our target in the report is 85%. I think the name of the report, right? The budget work group.
Sustainability.
Thank you. The sustainable work group report
Yes.
was to reach 85% or better or less. And so you can see that we're stabilizing at 85% last year, and in the current budget, that's what we're coming in at again. There was some variability in the COVID years, mostly due to the way the COVID money was spent. So the projections that we use for the assumptions that we use for the 5-year projections, we use the State Legislative Analyst Office COLA projections that you can see there. We did not, in the flat version, we did not have any additional decreases in international or out of state, which we talked about previously. Step and column increase of 1%, benefits increase of 4%, which is an average over multiple years. It's about where we get to. And that we were funded on the highest of the 3. So if you go to the next page, those are the actual numbers. And you can see that we have updated the adopted budget and then the following columns for the projected years. The adjustment line towards the bottom, it reflects the efforts that the college will make to resolve the budget deficit, right? So some of it in 26, 27, 50% of it or so, and then the remainder of it as we go forward. But in our projections, if no action were taken, we would still have a deficit too. And that primarily has to do with the fact that revenue is not increasing at the same rate that expenses are increasing.
Yeah. I had a couple thoughts. This chart is much better, but
Please.
but one is that we should have a line for policy reserves, the amount of the policy reserves, which is the 20% basically, even though we've got some deferral. I don't think we're in deferral for that calculation.
We are not.
Yeah.
It says either deferral or 15%, whichever is greater, and 15% is
Plus 5%.
plus 5.
Yeah.
Yes.
So I think a line that says the policy amount that we should have each year
Okay.
based on 20% of expenditures.
So that would be counted as a separate expenditure or how?
No, the amount of reserves is in current, for this particular calculation is 20% of expenditures, of total expenditures.
Okay, but on this chart, it would just be kind of like, you're just noting an amount, it's
Right.
not actually contributing to the total expenditure line.
No.
Okay.
No.
I think,
Noting the amount relative to reserves.
so the very bottom line is ending
Fund
fund balance. Oh my goodness.
Yes. Steve,
Fund balance, not fund balance. Thank you.
Yeah,
And then so right below that, we could put 20% minimum per policy.
yeah,
And then we could put a comparison to show we're above or below.
right.
Okay.
And then to go with that, I would add one more version here, the one that we're actually using for the budget, which is no increase for FTS, et cetera, right?
Yes, so
Yeah.
I pulled just this snapshot
Right.
out, but in the actual budget book, it says this is the flat projection, this is the increase projection,
Right.
this is the decrease
Right.
projection.
So I was thinking that it would help if people could see in a different one, if we didn't do anything, what you have now got is these lines with no change in our fund balance. You would actually subtract the 5,000,006, the 3,000,006, and the 1,000,006, and then you could see that comparison to our policy reserve amount. You see what I mean?
If no action were taken,
If no action were taken.
I see.
Right, so people could see that it matters. It somehow, the 5.6 didn't magically turn into 0. I know what you're doing here, but I don't know that everyone will.
Okay,
And I think, though I may have calculated it wrong, we would be under policy reserves if we did nothing. So,
okay.
Yeah, can you explain a little bit more about that adjustment line? So you're saying that this is future efforts to rein in the budget.
Correct.
How did you come up with those numbers there? I mean, they vary, from 3.3 to 5.6 and then 1.6. So just kind of curious where those came from.
Sure, so the difference between total revenue and total expenses is where the individual numbers came from. And then the board has asked us to have a balanced budget by 27, 28.
Okay.
Right, to present to the board in June of 27. And so that's why the adjustment starting in 27, 28 accounts for the full difference. Whereas in 26, 27, it accounts for half the difference.
Oh, okay.
Because we're making efforts in 26, 27, and then we've fully resolved whatever the issue is in whatever ways that we do by 27, 28.
Okay. All right, thank you.
Sure. That's what, at least what it's meant to represent.
right. And I appreciate the fact that we're saying we really mean to do that, and that's
Mhm.
why we're not subtracting these numbers from our reserves. But I think keeping that comparison if we didn't, because some people think, we're overselling.
Sure.
Uh.
So if we did that at the top of the page or something, we could
Yeah.
put some sort of label that says, if action were taken, this one.
Or if no
If
action,
no action were taken, this one.
right, right.
That makes sense. Any other questions on this page?
Oh, Cornelia.
Thank you. So, quick question on the FTES numbers.
Yes.
Because I somehow thought that as of, at least as of this year, we are now have 3 years of own FTES. So that there's no more inflated, pre-COVID inflated,
Correct,
subsidized year in there.
correct.
So,
Emergency conditions allowance.
yes, so.
When you say this year, which year are you meaning?
25, what are we in, 25,
24, 25,
24, 25?
unless you
Well,
just
we're in
25, 26.
We're in 25.
25, 26,
Yes,
yeah,
yes.
so this year.
Yes,
So my question is, if we are assuming a constant FTS going forward, why would we next year decrease our average?
because it's on a 3-year rolling average.
Right, but haven't we gone up the last 3 years?
Because the emergency conditions allowance is coming off slowly,
Yeah.
so the amount,
We are done with that,
but
not fully?
the amount that we were funded in previous years included emergency conditions as part of the 3-year average.
Yes.
But now it does not,
Yes,
right? And so although the funded amount, the average for the funded amount may have been higher, the actual FTES was lower than that. We were funded higher than our actual. And so as we apply the actuals to the 3-year average, it adjusts down. That's why you see it going from 9,735 to 9,285 and then down to 9,188, because the actuals are catching up on that 3-year average.
What line was that?
right.
It's
Second
Person
from the
the
top.
credit FTES
Oh,
3-year
right,
average.
I see,
Yeah, I just thought we had been, like, we are done with having anything inflated on the back end of that 3-year average. I thought we already clean. We're not. We are already kind of done with all inflated numbers.
We do not get emergency conditions allowance protections in 25, 26. That is true.
Okay, maybe I need
but
to
in
think
terms-
through that more, but.
In terms of the 3-year average, we're still catching up,
Correct.
is what you're saying. So
The,
that's the difference.
Yes.
the other question I have also on FTS is what you said earlier about the summer shift.
Yes.
So we used summer 2020, where is it? 2024 money. We have used summer 2024 FTES
In 2023, 24.
to help boost our 23-24 FTS.
Correct. So we used summer 24 FTES to help boost 23, 24 FTES for the purpose of the calculation.
Yeah,
Because we knew that the amount we get in 24, 25 is the previous year's calculation plus COLA. So we wanted that calculation to be as high as possible,
correct.
so that 24, 25 would be as high as possible. And the real reason is that 24, 25 became the floor. So after 24, 25, that's the minimum that we'll receive. It won't go below that. And we wanted to make our floor as high as possible.
Yeah, and that's totally clear, and
Yeah.
my question is now, what's happening with the summer 25 FTS? In which year do those go?
In the whatever year they normally would.
In which year do they normally go?
They would probably land in 26, in 25, 26.
In 25, 26. So that means 24, 25 would be then out of summer FTS, or would we?
Depends on when the
Some.
class starts and finishes. There are some
Yeah, they are,
classes that
right.
finish
Yeah.
in June.
If they end in June, they would belong to the prior year. If they
Right.
end after that, they belong to the next year.
Right.
That's typically how we've done it.
Yeah.
So 2023 summer, did we have 2 sessions or 1?
Do not know.
We had one. I
We had
think.
And that went
It was our
also,
first semester, I think. when
and
we
that
had
went to 24, 25 also. Right?
23, 24
It
year.
would be part of the
But-
23-24 calculation that would have helped funding
Yeah,
in 24-25.
right.
But
So
we
we-
didn't just have
Uh-oh.
one length of classes though, correct, Maria? We had, you know, one length and then we had a couple of shorter ones. So we had flexibility because it wasn't just a single schedule.
We had one term, but we
Right.
did have classes that started, we had back-to-back classes, for example. Is that
Right.
what- Yeah, so we had some classes that started in June and others in July, but we had one summer session versus two summer sessions, which was summer 22 was the last summer when we offered two different summer sessions.
So it was one overlay
Yes,
session, but then there were individual differences within there.
yes.
Mhm.
Okay. But what I'm getting at, I think, and you're indicating there's some variability that summer 23 and summer 24 both goosed
Yes,
we were counting 2 summers in 1 year for,
Correct.
to raise our
Our floor.
floor.
Yes.
Mhm. Then there was one last question. So, okay, so I wanted to go back to the adjustment line that trustee Richards.
Which page are we at?
On page 19,
Oh, okay.
referred to, yeah. So we are planning to basically reduce our expenses by about 3.4 million next year. That's the plan.
Yes, that's what it's meant to represent. Correct.
And then the 5.6 in 27, 28, that's on top of the 3.3?
No,
Or it includes the 3.3. So
It includes.
once we were successful in cutting $3.4 million in expenses in 26, 27, then there's only 2.2 million left over to additionally cut in 27, 28. Is that right? Did I understand that right, or is that both?
I would have to take a look. Each one is a comparison. Each year stands alone as a comparison between revenue and expenses. And so, yes, 3.4 in 26, 27, because you're comparing those. And you can see, based on COLA assumptions, which may not play out, that revenue increased in 27, 28 compared to 26, 27. And expenses also increased.
Yeah.
The difference between the revenue increase of 3.5 and the expense increase of 2.3, right?
Mm.
So I think it's the difference plus that additional
Okay.
change. But it all depends on if COLA plays out, for the revenue part, if COLA plays out in the way that the legislative analyst office predicts, or if international and out-of-state revenue behaves in the way that we have it in this projection, which it might not, it might be higher, it might be lower. So
And
by its nature, projections are inherently inaccurate.
the salary increases that you projected in the out years.
Yes.
Compared to the current year. Are these COLA increases?
No, we just did a 1% to reflect step and column changes. And that's, I believe that was on the previous slide.
Oh, okay, yes. And so, I mean, $3.4 million is a huge amount.
Yes.
And it's what you're saying is that it happens twice in 26, 27, and again in 27, 28, plus another 2 million?
Here's the thing. We don't want to predict because we don't know yet what changes we're going to make in order to accomplish that savings.
Yeah.
So the dollars in the categories above, under all of the expenditure categories, we kept as they were and we just applied standard increases, as we noted on the previous pages. So the adjustment is just meant to represent what those changes are. As we make those changes, we'll be able to see in the various categories where the differences are as we move forward. But since we haven't made those changes yet, I didn't want to presume the changes. So we just left it as a single line to reflect adjustment activities.
But that line represents the challenge that we face in reducing our budget to meet the line below it, which is balanced.
Yes. Yes, it does.
So it's not a small number.
It is not. Now, one good thing that you'll see on the board agenda, and we've talked about it before, is the scale microgrids coming to campus. So that agreement is on the board agenda. And we predicted a 10 or 12% increase in electricity expenses for this year. Once that agreement is in effect and they're done constructing, they limit our increase to 2.5%. So that's definitely a future impact on expenses that keeps that change much smaller than it has.
That'll be part of the plan.
That's part of the plan.
Yeah, and actually I had a question about that because on slide 15 where it lists the different amounts, the electricity looks like it's projected to go down in the next coming year. Is that because of that? Or what would drive that? Because those won't go online for another couple of years.
That's actually the actual difference between what we spent in 23-24 and what we project we have spent in 24-25.
Okay, so it's just electricity.
We use less.
We use less.
We use less because the rates certainly go down.
Yeah, that's what I'm thinking. Okay, so there must be something else going on.
One of those things that we were able to remedy that may have made the difference for us, the external lights on Cliff campus, many of them were stuck on all the time, even during the day. And we were able to repair the controllers for those lights, and so they don't turn on in the days like they used to. So I think that made a big difference.
Wow, okay.
It was terrible that literally 24 hours a day, those lights were on.
Yeah, okay, well, that's good.
Yeah.
Okay.
Okay, so I think we've talked through the takeaways already, but switching to standardized attendance accounting helps us move into stability. Unless action is taken, the deficit will persist. It could worsen or get better if international or out-of-state revenue declines or increases. And SPCC leadership is committed to working with all constituencies to resolve the deficit issue. Any additional questions? Good suggestions as we went along. I will make updates and send you to the updated presentation. Thank you.
Thank you.
And we'll find the fund and make it fund.
I'm pretty sure we could figure out what that was supposed to be.
Yeah. I didn't even see the title until I was reading it. I went,
Okay,
"Ah."
are we done with budget? Or you want to go through the other?
No, the only reason I added the informational items for the board policies was in case we wanted to talk about that question that I raised, if the board had a desire to make changes to the budget partway through. And I think we sort of talked through it. So VP 6200, I highlighted the bullet point, changes in the budget assumptions upon which the budget was based shall be reported to the board in a timely manner during the fiscal year. And I think we talked through that. And I think the recommendation from this committee to the full board is not to change the budget, but just to get updates as those things occur.
Right, and give us a cumulative sense of what those updates mean.
In terms of
Cumulative.
dollars.
Now,
Yes,
obviously, if we just learned that the HSI grants were canceled and we were between reports on that, we
Yes.
would expect to
yes.
get that news.
Let's not have that.
Yeah, so I guess I'm just wondering about that because to me, I think there would be value in revising the entire budget so that you'd have a clean document That, because otherwise you have a budget and then you have to kind of go through a list of footnotes about, well, the adjustments that, you know, are in there, but aren't really in there. You know, I guess that's what I'm not really, so I'd like to try to make it as clean as possible so that when someone's looking at what the budget is for the year, that they get an up-to-date, you know, accurate document. And what we're saying here is that we'll have a budget, but then there will be some adjustments made or reported to the board along the way. But where will, if you were just looking at what the budget was mid-year, so say, you know, you're, you know, looking for what the budget is in January or February, and you come across a budget that was adopted back in June, or I guess September, you know, there may be some differences in there that would be important to know about. So I guess my question is just how is that going to be reported, you know, so that someone for ease of reference can look at what the document is and know that it has all the most up-to-date information in it.
So we maintain, Business Services maintains a budget webpage, and we keep the tentative and adoption budgets on that page for multiple years. If it was the board's interest, we could provide these cumulative updates and then post those updates to the same page. It would be saying actuals may turn out different than what the budget says, but it won't actually change the budget itself. Unless that's the will of the board, in which case we would do that.
Well,
Which
and
is the
if I
process
can,
we've done.
if I can pop in here, I think it's important, just in seeing all the shifts that you saw just in that one presentation, I would be hesitant to, you know, definitively change a budget at this point in the year, then definitively change it. I agree that probably what we want to do is make sure we have an adequate history of here was tentative, here was adoption, here was what we did in January, here's what we did in March after we saw recalc, you know, all of that. I think that's a great idea. I just want to make sure everybody knows that we can do that, and we can still find out in May that the numbers came in differently. And I just want to make sure I don't want anybody to say, but you said in January. Well, yes, and this is how it changed. So
Yeah.
that's my concern.
Yeah, and I mean, Jet mentioned earlier, you know, this is dynamic, it's a dynamic process, it changes, you know, it's never gonna be, you know, done. You know, I mean, we always will have more information forthcoming that we can incorporate or not, or, you know, or at least advise us about things. So I think whatever we have, it just is about, you know, making sure that the most up-to-date, you know, revised data is included with that.
Yeah, I think that's good.
Okay. We can
I
certainly-
mean, we're used to seeing budget adjustments from time to time.
Sure.
And I'm not saying you shouldn't do that if you want to do that. I'm just saying that you get this, you have certain major points where you can really verify or unverify what you originally assumed. And that's why it's about assumptions, you know.
Right.
Assume this much revenue, it looks like it's going to be something different, and here's the number.
So just so I understand, just going back to this adjustment line,
Yes.
that's the number that we kind of want to have written on our soul, right? Like that's the number we're trying to get to. We need this adjustment to happen this year in order to get us to balance by 27, 28. Is that correct?
Yes.
Okay. So then in the reporting, would it be possible to get occasional updates on like, not this whole thing, but just like, we're trying to get to 3.4 million. So far we've hit 1.5 and here's how we've done it.
Yes.
Like, I think that would be really helpful. Okay.
Yes. So those quarterly updates, would that be a time to?
Yeah,
Okay.
absolutely. Yeah.
That's good.
Okay.
It sounds like it would have two parts, what you just described
And
and
then
what we
saying,
described in terms of changes in assumptions.
exactly. Yeah, I think that would be good.
Yeah.
Sure.
Yeah, no, I'm not suggesting a dollar by dollar, blow by blow of what we're saving, just combined with any regular reporting. I think it would be good. Yeah.
We wouldn't want to bore you with accounting speak on the dollar by dollar. Oh, I have to have a lot of coffee.
Yeah. So the reason you brought those policies was to have this discussion and you feel like you've got the answer.
I believe I do.
Okay.
Hmm.
Anyone else? Any other questions, issues, items for future consideration? We know that you're going to be bringing us something next time on
Yes.
the total cost of ownership.
And the 311.
Cornelia?
Yeah, it's this FTS shifting still is driving me a little bit. Because I looked at the summer schedule and we started summer on June 9th. That means only like if we had any, I don't know if we had any 3-week classes. Only a 3-week class would still count towards the old year. And so I'm just, again, it's just a question how this is impacting things. So assuming that we are not shifting any summer 25 FTS into 24-25. It appears to me that we will have pretty much 0 summer FTS in that year. And I'm just asking, how is that impacting anything in terms of our 3-year average? If we have in our reporting probably a dip because all the summer 24 FTS went into the 23-24, all the summer 25 FTS go into 25-26. No summer FTS pretty much, except we have a few 3-week classes in 24-25. That must kind of reduce how much we report. And I'm just asking, how is this affecting anything?
Well, okay, so 2 things. First, the 320 report, which is the report we provide to the state on FTES, the final recalculation for 24-25, we have to report to the state by the end of October.
Mhm.
So we can have a better sense of that actual data in November.
Mhm.
And then the decision we made in 23-24 to move the FTES, which does result in a change in reported FTES for the formula for 24-25. It does 2 things. First, it bumps up 24-25, which we've talked about.
23-24.
Yes, the 23-24 calculation, 24-25 funding.
Oh, funding, yeah.
But you're right, it also moves the FTES for the purpose of the 3-year average calculation. It most definitely does. Now, because it is a 3-year average for the year in which 23-24 is included, right? So this year is 25-26. Our 3-year average this year will include 23-24, 24-25, and 25-26 for the credit portion, right? So this year, it includes that FTES anyway,
Yeah.
because it's looking at those 3 years. Next year, it won't include that FTES. So it does impact the growth at which the 3-year average changes, but on the flip side, it increases the minimum that we can receive from the state. So it's a strategic decision, not without pluses and minuses.
And this minimum, I'm totally like for that. It just thinking that through, that's the minimum we, kind of the worst case scenario, right?
Yes,
The minimum,
correct.
which we hope we will not have to fall back on because we hope for stability.
Correct. As you saw looked at the numbers, based on the way they did the formula for this year, we are in stability and we're ever so slightly above that floor, right? The floor was for the student center funding formula part was 103,850. We are $141,000 above it, ever so slightly. And that's just because of the way that averages are working, right?
No, and again, I totally support that we shifted this FTS back. Last question, I promise I shut up. So when would we have, I assume we could still make depending on how things fall out and how things change, the district could still make the decision on taking some of the summer 25 FTS and count them towards the 23-25. Is that correct? And how much time would you have to make that final decision?
I'm not familiar when the requirements are for making the notification to the state that we're going to count them when they start versus when they finish. I don't know that. I think for 24-25, we may be past that date,
Oh, okay.
to be honest. But we have to be careful with that because you shift 1 year for a purpose, and then if you're constantly chasing that shift, that means every year you're moving it from 1 year to the next, and you never actually get to the point where you're counting it sort of in this standard year, so to speak. So I think in this sense, because we increased our minimum, it's actually better to let that play out now.
With the dip.
Mhm.
In
Reset.
25, okay.
Yeah.
And can I add here too, that we have to be very careful about it too, because there are some legislators who have the summer shift in mind. In fact, I think it was maybe a year ago that we were getting lots of questions from the chancellor's office, both directly as a college, and then the CEO board was getting questions, because there are some legislators who think that if and when you do the shift, you're gaming the system. And to some extent, it's correct, less so now that we don't have a pure FTES model versus, because with the 70%, and then with the fact that, and this is an important point, our dual enrollment sections do not count towards our rolling 3-year average. And there are a lot of districts out there that invested in dual enrollment thinking that it would up their 3-year average, only to find out it doesn't. And so I feel like we're taking a really good conservative approach to it. And we have to go by the dates that are established for making those decisions. But I think Maria and her strategic enrollment folks who have been looking at these kinds of things, I think they've got a pretty good handle on it.
Okay,
Thank you.
thank you, everybody.
All right, thank you.
I hope that was helpful.
Yes, absolutely. Always appreciate good feedback.
There you
Thank you, everyone.
Yes, thank you, Erica. I guess we're adjourned.
go. All right, thank you all.
All right, thank you.
Yeah.